dear friends. In our last session, we explored the costs of monitoring loans, managing the risk of defaults, and handling delinquency in microfinance. We discussed how MFIs balance the need for loan oversight with sustainability, using strategies like digital tools and flexible loan terms to manage repayments effectively. In this session, we will dive into the use of artificial intelligence in credit assessment and explore how technology is transforming the microfinance landscape. Now meet Aisha, like millions of others in underserved communities, lacks a formal credit history. In the past, this would have prevented her from accessing financial services. But with advancements in technology, particularly the use of artificial intelligence, credit assessment is no longer the limitations to traditional methods. Today, microfinance institutions are leveraging AI to bring financial inclusion to people like Aisha, using new ways to assess creditworthiness and reduce risk. Artificial intelligence is transforming the world of microfinance. In today's session, we will explore how this AI-driven credit assessment works, what kind of data are used, how machine learning predicts risk, and the ethical considerations that come with these technological advancements. To begin with, now let's look into the need for AI in microfinance credit assessment. Many microfinance borrowers, like Aisha, operate in informal economies. They have irregular income streams and little or no access to traditional banking services. This lack of formal credit history makes traditional credit assessment methods inadequate. Conventional credit scoring relies on formal records such as borrowing history and payment behavior. But many microfinance clients don't have these. In rural areas or among informal workers where income is often inconsistent and undocumented, assessing a borrower's creditworthiness becomes a challenge. Starting with limitations of traditional credit assessment. In absence of formal financial histories, MFIs struggle to gauge risk using traditional methods. Borrowers like Aisha may have never taken loan from formal institutions, leaving MFIs uncertain about their repayment capacity. This gap in information increases the risk of lending, often resulting in either overestimating or underestimating the borrower's ability to repay the loan. Towards our second point, how AI addresses these challenges. AI can help fill this gap by leveraging alternative data sources, automating credit decisions, and improving efficiency in the credit assessment process. By analyzing patterns in non-traditional data, AI can create a comprehensive picture of the borrower's financial behavior even without a formal credit history. AI-driven credit assessment systems are faster and more accurate than manual processes. This allows MFIs to serve more borrowers and disperse loans effectively, while simultaneously reducing the risk of default. Now, let's dive into data collection and analysis for AI-driven credit assessment. For AI to assess credit worthiness, it needs data, lots of it. But what if there is no formal financial records at all? AI solves this by collecting and analyzing alternative data such as mobile phone usage, utility payments, and even social media activity. Mobile phone and transaction data. Mobile phones are at the heart of this revolution. In many developing countries, mobile money platforms have created digital financial ecosystems where users can send, receive, and save money through their phones. AI can analyze this data, tracking patterns in income, spending, and saving habits. Even call and text patterns can reveal a borrower's financial behavior. For example, consistent mobile phone top-ups or regular communication can indicate financial stability, helping AI determine a borrower's repayment capacity. Utility and bill payment data. Utility and bill payments are another important data source. Consistently paying bills like electricity or water on time shows financial responsibility, which AI system use to predict loan repayment behavior. AI tracks whether borrowers pay their bills on time, using this information to build a profile of financial discipline even if the borrower has no formal banking history. Thirdly, social media and behavioral data. AI can also analyze social media activity using behavioral patterns to gauge creditworthiness. Borrowers with stable online profiles and strong networks are often considered lower risk than those with erratic behavior. AI can identify key behaviors that signal reliability or risk, giving MFIs another way to assess borrowers in the absence of formal financial records. Psychometric data. Psychometric data is an innovative approach where borrowers complete tests that measure personality traits, risk tolerance, and decision-making abilities. By analyzing these tests, AI can determine whether a borrower is likely to repay their loan or take on too much risk, helping MFIs make more informed lending decisions. Now let's look into machine learning in credit risk assessment. At the core of AI-driven credit assessment is machine learning, a type of AI that allows systems to learn from data. Machine learning can analyze historical data to predict future borrowers' behavior, helping MFIs assess the risk of defaults more accurately. Predictive modeling. Machine learning models are trained using historical loan data, identifying patterns that correlate with default risk. These models can predict which borrowers are likely to struggle with repayment based on factors like income fluctuations or spending behaviors. As new data comes in, the machine learning model continuously updates and refines its predictions, allowing MFIs to adopt loan terms or offer additional support if needed. Fraud detection. Machine learning is also highly effective at detecting fraud. By cross-referring data points, AI detects anomalies in borrowers' information, such as mismatched phone numbers or falsified documents, preventing fraudulent loans from being disbursed. Credit scoring. without traditional credit histories. One of the biggest advantages of AI is its ability to generate credit scores for borrowers who have no formal credit history. By integrating data from mobile transactions, utility payments, and social media, AI can create a holistic credit profile. This allows MFIs to serve a wider range of clients, offering loans to those who are traditionally excluded from the financial system. Now let's see, what are the ethical considerations in AI-driven credit assessment? While AI-driven credit assessment has many benefits, it also raises ethical concerns, particularly around data privacy, algorithmic biases, and transparency. Data privacy and security. Borrowers must be informed about how their data will be used. MFIs need to ensure that data is securely stored, encrypted, and protected from unauthorized access. Algorithmic bias. AI systems are only as good as the data they are trained on. If that data contains biases, the AI could unfairly penalize certain groups based on gender, race, and socio-economic status. To avoid perpetuating bias, MFIs must regularly audit their AI models, adjusting them. AI systems are only as good as the data they are trained on. If that data contains biases, the AI could unfairly penalize certain groups based on gender, race, or socio-economic status. To avoid perpetuating bias, MFIs must regularly audit their AI models, adjusting them to ensure fairness across all borrower profiles. Transparency and accountability. One of the challenges of using AI in credit assessment is transparency. Borrowers like Aisha deserve to understand how AI makes credit decisions. Explainable AI helps MFIs provide clear reasons for loan approvals or rejections, building trust between the institution and the borrower. Therefore, AI is revolutionizing the way credit assessments are conducted in microfinance, making financial inclusion possible for millions of people who were once excluded from traditional financial systems. By leveraging alternative data, machine learning, and predictive models, MFIs can more accurately assess risk and offer loans to a broader range of borrowers. As AI continues to evolve, MFIs must balance innovation with ethical practices, ensuring that the technology serves both the institution and the borrower in a fair and responsible way. Thank you all for watching. Stay tuned, stay connected. Good day.